Hi all, we've all seen projects out there that are offering ridiculously high staking yields, whether it's up to 100%, 500%, some of them are like 10,000% plus. But you're actually going to make any money? Are you going to double your money in 12 months by investing in a company that offers you 100% APY over the 12-month period? Those are the questions we're going to answer in this video to allow you to make investments safely and wisely to maximize your profit and minimize your chance of loss. That being said, this is not financial advice. I am not your financial advisor. This is just an educational video so you can make the right decision for you. Okay, so we're going to cover what APY and inflation actually are. We're going to tell you how you can find out the inflation rate of the platform that you're trying to invest in, and this information will give us the real rate of return, or at least how we can work out the real rate of return of how much money you're going to get for your investment. And that'll allow us to make the considerations of a wise investment rather than just throwing our money at something because it says that you're going to get a high yield for staking of them for 12 months or whatever. It might sound boring and it might sound complicated. It's not complicated. It might be a bit boring, but it might allow you to make a more educated decision on what platforms you're going to invest in. So potentially more money for you. So the APY is your annual percentage yield, and it's used across all financial platforms to compare interest rates. You know, it's not just in the crypto world. Obviously, we've got mortgage rates and interests of what we earn for what we leave in our bank, even if that is just 0.000 whatever. So if you're offered a 15% APY, investing $1,000 in it for a 12-month period, then at the end of that 12 months, you're going to get an extra $150, which is the 15% of your $1,000 original investment. So you've got 1,150 in total. But some platforms will compound your interest daily for you automatically. Some of them are weekly, some of them are monthly, some of them are intradaily. So like you'll just keep clocking up and up and up and up to get you the best APY as you can. But you know, if it is annually or if it is daily, then that's the sort of information that you want to look at a project for. Look in their white paper for the staking or whatever and find out exactly what you're getting, so you know you're getting the best return for your money. Now, if we use the example that we did a minute ago of 15%, and you put this into a compound interest calculator, so if you've got your $1,000 in a project, 15% rate, leave it in there for 1 year, and you don't compound the interest, you get your 1,150, like we said. But that same investment, if you leave it in there for a year and it was compounded daily, you'd get 16.18%. So you're actually receiving a little bit extra. I know it might not seem much for a small investment like, you know, $1,000, but it all adds up. So if we have a look at Pancake Swap, we can see over here that they've got these two here now, that one's auto, so it will auto compound for you daily, and then this one is manual, so it won't auto compound for you. And you can see the significant difference in how much they're offering for their interest. Now they give you a little calculator here, and if you were to compound it daily on the manual, then you'd actually be receiving 66.3, which, you know, is pretty much a little bit higher than the auto one. So you can see how significant the auto compounding or compounding daily can be to your investment. That being said, this 65% APY stands out, doesn't it? It makes it sound amazing. If you put in $1,000 into that beginning of 12 months, in another 12 months time, are you going to have an extra $650 from your investment? Well, that leads us nicely onto inflation. So inflation is the rate at which the monetary base expands. So any financial platform can suffer inflation. If you're holding shares and they raise more money to create more shares, then your holdings are being inflated away. If you've got hold dollars, pounds, euros, whatever in the bank, and the government prints more money, then your wealth is being inflated away because your current holdings are being diluted. But you can also get deflation. In crypto, we have coin burns where they reduce the amount of coins in existence. They literally just burn them away, can't be used again. And you get the same sort of thing in shares with share buybacks. Now, we track these changes of inflation and deflation in percentage. So it's easy for us to see like the percentage change in inflation, deflation. It makes it a lot simpler. Now, in crypto, we generally get inflation, or we do get inflation, caused by a creation of new tokens. So a platform might create more tokens as an incentive for people for staking, mining, or liquidity rewards. But every time they're creating more coins, they're increasing the inflation rate, and it's diluting the existing holdings of like their customers. So if you've got a company with 10 million coins in existence and you own 1 million of them, then you own 10% of that company, that platform. But if they decide that they want to create another 10 million coins for an incentive for people to stake on their platform, then your holdings have now gone down from 10% to 5%. And if they were to release these 10 million coins straight away, the market cap being exactly the same, then that's going to half the price of the current price of the tokens. As it happens, they'd probably release them over like a 3-year period or something. But it shows the importance of why you need to check the white paper on the projects that you're investing in to see how these staking rewards are going to be released, so that you're not caught out short with a large amount of tokens that are constantly decreasing in value because there's more and more and more being created. If we use Bitcoin for an example, it's a really good example because Bitcoin's nearly been mined to the point of completion. So this is on CoinGecko. It tells us the max supply is 21 million. There will not be any more created when that 21 million are in existence. And the circulating supply is nearly 90 million. So there are very few left to create. And then so if you checked on, this is Messari.io, and went on to Bitcoin, we can see the inflation rate of Bitcoin, and it's considerably low because of how few there are left and how difficult it is to mine Bitcoin. So you can see the rate is only 1.78%, the inflation rate, which is fantastic. It's really low. But the way Bitcoin works is, back in the day when it first came out, you could easily mine Bitcoin. It was easy to create. But now, as it's gone further and further down the line, every 4 years they do a halving and they reduce the amount of Bitcoin rewards by 50%. So their miners are, they can still mining away. It's a proof of work blockchain, so it keeps the network safe. So they want to incentivize people to continue mining it, but then the rewards are constantly being reduced, so the inflation rate is constantly being reduced. If we looked at PancakeSwap from earlier, so they give a 65% yield, and then if we looked at that on Messari, PancakeSwap, they have in metrics a 70% inflation rate. They're given 60, you'll be gaining 65% in yield, but the inflation rate is 70%. If you had a look on CoinGecko at PancakeSwap, it would tell you that they do not have a max supply, so they can constantly keep creating more and more coins, constantly devaluing the total value of the coin, deflating the value of the coin. So unless they get more and more people invested in it to increase the market cap, then the price of the token will continually fall. And with these two bits of information of 65% APY and 70% inflation, then we can work out the real rate of return. So how do we calculate the real rate of return? So there's an easy way. We all like an easy way, and there's a hard, more accurate way. So the easy way, we've just got, you can just take your yield minus your inflation, and that gives you your real rate of return. So what do we have for staking cake on pancake swap? You get 65% yield, 70% inflation. So your real rate of return is actually minus 5%. But if you want a more accurate answer, then if we use this example, 10% yield, 5% inflation gives you 5%, but in reality is that's not perfectly accurate. So you need your nominal rate, which is your yield percentage, and your inflation rate, which is your inflation percentage. So you'll do 1 plus your yield as a decimal, so it's 1 would be 100%, so it's 0.10 divided by 1 plus your inflation rate as a decimal, so 0.05. So you've got 1.10 divided by 1.05 equals 1.0476. As a percentage is 4.76. So you can see there's only a small amount of difference, but if you invest in millions, hundreds of thousands, whatever, then you're going to want to have a more accurate answer because it's going to be more significant to yourselves. So now we know the real rate of return. I'll move on to the considerations that I make before investing. These are just the ones that I make. It's not necessarily going to be right for all of you, but it's up to you if you want to use them. It's just education purposes. So I want to know the inflation rate and the real rate of return because I want to know if I'm staking in the project, for example, and the yield is significantly lower than the inflation rate, then I'm just kind of constantly be devaluing the investment that I put into the project. And the only way that the coin's going to go up is if loads more people start investing in it, increasing the market cap. But why would they do that if the inflation rate was significantly higher than the yield that you're getting from it? So that's one of the first thing and the whole point of this video, I suppose. But if they have got a large amount of tokens to still be released, it's not necessarily a bad thing. You can look at the white paper and see how they're going to release them. If they're going to release them gradually over a period of time, or it's a sensible release period, then it's not going to cause the inflation to be too bad, or if it is, then the yield's significantly more, then it might be worth doing it. But be aware that the yield can change just because it starts off at a 5,000% yield, and it can go down. They can entice people in there with a high yield, and then it can reduce, but when more and more people are in there, for example. But you can't just go off what the APY is. Basically, you've got to look at a project, and if you think it's a good project, then have a go on it. I, for example, invested in Illuvium. Illuvium, from all the information I've given you in this video, would be a terrible project to invest in, because it's a long way away from its max supply. It's only got just over 600,000 tokens in existence, and there's 10 million to go. It was giving staking rewards or liquidity pool rewards of like 600% when I started investing. It's still ridiculously high now, and if we have a look at it on Masari, it will have a very high inflation rate, see 416%. But from looking at the white paper, I know that the team, for example, have said that they're not going to take their tokens out they're locking their tokens for 3 years. And I know that from the staking rewards are locked for a 12-month period. So that 12-month period ends in March. So as of March, I fully expect the price of Illuvium to start going down, and I won't still be invested in at that point. But I will get back into it when it comes right back down. But you can see here the fully diluted valuation is nearly 10 billion, but actual available tokens is only 630 million. So there's a significant amount of locked valuation in there. And so I wouldn't invest in it at the moment, but I will invest in it once it finds a new equilibrium and a more sensible price, for example. But yeah, so if it's a good project and the inflation rate's not great or whatever, but if the rate of return's acceptable and it's a good project, then by all means have a go. It's up to you. It's your investment at the end of the day, isn't it? Just make sure that you're taking profits along the way. I took profits of Illuvium when it was at $450. It went up to $2,000 near enough. I could have made significantly more, but I wanted to take profits to cover my original investment. I've still got money in it. I'm happy with that, but I'm not kicking myself that I took it out early. It's just that take profits in these projects as you're going along the way. Don't just hodl until it gets to the moon, because otherwise somebody else will sell before you and you'll be left with nothing. But I'm not saying that pancake swap's a bad investment. I'm not saying Illuvium is a good investment. I'm not saying that Bitcoin's a good investment. I'm just giving you the information so that you can work out whether the APY that they're offering in some of these platforms is as significant as it may look on face value. So I hope it has helped. I hope you can make more educated investments now, and thank you very much for watching.